Most people think Warren Buffett's edge is genetic, a math brain, a photographic memory, or just the dumb luck of being born in the right country at the right time. That's the comfortable story, because it means you don't have to do anything about it. The real answer is a 75-year-old book written by a Columbia professor that most people have on their shelf right now and never actually understood. Buffett called it the best book on investing ever written. But the word investing is doing a lot of heavy lifting in that sentence, because what Benjamin Graham actually wrote in the book The Intelligent Investor was not a manual for picking stocks. It was a cognitive operating system for making rational decisions in an irrational world. This video is not about picking stocks. It's about the mental framework that separates people who build lasting wealth from people who stay perpetually busy and perpetually broke. And there is one principle inside this book, one specific idea that Buffett has used to filter every major decision he has made since he was 19 years old. We will get to exactly what it is and exactly how to use it. But first, you need to understand where it came from. Benjamin Graham didn't build his system in a classroom. He built it in the wreckage of his own financial life. Before the 1929 crash, Graham was one of Wall Street's most respected analysts. He was running money, generating strong returns, and by most measures, he was winning. Then the market collapsed, and Graham, who understood finance better than almost anyone alive at the time, lost nearly everything. Not because he was stupid, because the system he was operating inside had no protection against catastrophic failure built into it. He was brilliant, and it still almost destroyed him. That experience didn't break him. It forced him to think from the ground up about what rational investing actually looked like, stripped of all the noise and the optimism and the crowd psychology that had pulled even smart people over the edge. By the time he published The Intelligent Investor in 1949, he wasn't writing theory. He was writing a survival guide, a set of hard-won rules for people who had already learned what happens when you operate without them. The book wasn't aimed at Wall Street professionals. Graham wrote it for ordinary people. His argument was that you don't need superior intelligence to outperform the market. You need a specific kind of discipline, the discipline to think independently, to base decisions on analysis rather than emotion, and to protect yourself from the single biggest threat to your financial future, which wasn't the economy, wasn't inflation, and wasn't bad luck. It was you. Buffett found the book at 19, working through the Omaha Library. He has described reading it as one of the most important intellectual experiences of his life, not a mild recommendation, but a genuine before and after moment in how he thought. He was so affected by it that he drove to Columbia University specifically to study under Graham in person. This was not admiration from a distance. It was the kind of obsession that makes a person reorganize their entire life around a set of ideas. Graham's foundational argument, the one that everything else in the book sits on, is this. In the short term, the stock market is a voting machine. It registers popularity, sentiment, and fear. In the long term, it is a weighing machine. It measures actual value. The problem is that most people spend their entire financial lives reacting to votes and never once stopping to ask about the weight. Now here's why this matters if you have never bought a single stock and have no intention of doing so. Your business operates on the exact same mechanism. The market around you, clients shifting to competitors, trends exploding overnight, a bad quarter that sends everyone into panic mode. That is all voting. It is an emotional, short-term, crowd-driven signal that tells you almost nothing about the actual underlying value of what you are building. Most founders react to votes. They chase the trend, match the competitor's move, restructure the team after one rough month. Graham's system is built on a completely different premise. Learn to measure weight, and you will never be at the mercy of the vote count again. Before we get into the formula itself, we need to understand the mental model Graham built everything on. And it starts with a character he invented, a fictional business partner he called MSR Market. Graham could have explained market psychology with charts and regression tables. Instead, he invented a character that became one of the most useful thinking tools ever put into a business book. Here's the setup. Imagine you own a share of a private business alongside a partner named Mr. Market. Every single day, without fail, Mr. Market knocks on your door and offers to either buy your share of the business or sell you his. Some days he shows up grinning, practically vibrating with excitement, convinced the future is limitless, and the price he names reflects that. It is high, sometimes absurdly high. Other days he shows up pale and sweating, certain that catastrophe is around the corner, and he will practically give his share away just to get out from under it. The number he quotes has almost nothing to do with what the business is actually worth. It has everything to do with how he feels that morning. The key is this: his price is a reflection of mood, not value. Here's the part Graham wants you to burn into your memory. You are never obligated to do anything. You do not have to buy. You do not have to sell. You can close the door, go back to work, and wait. Mr. Market will be back tomorrow with a completely different number, because that is what he does. His job is to give you options. Your job is to only take him up on one when the terms genuinely work in your favor. Most people do the opposite. They treat Mr. Market's daily price as information, as a signal about reality, about their own judgment, about whether they are winning or losing. When he is euphoric, they feel validated. When he is panicking, they panic. They have handed him the keys to their emotional state and their strategic decisions simultaneously, which means they are essentially being managed by a fictional character with a mood disorder. Buffett did not just understand this metaphor, he built his entire investment career around exploiting it. When Mr. Market panics, when everyone is selling and the prices look catastrophic, Buffett treats it as a discount rack. When Mr. Market is euphoric and prices everything at a premium, Buffett sits on his hands. He described it once by saying that the market is there to serve you, not to instruct you. Most people have that relationship completely reversed. Now pull this out of the stock market entirely and look at your own business environment. Every week, your version of Mr. Market shows up. A competitor raises a funding round, and suddenly every founder in the room is questioning their own model. A new platform explodes, and the noise tells you that if you are not on it by Friday, you are already dead. A client churns, and the story your brain writes is that the whole thing is unraveling. That is Mr. Market at your door, anxious, loud, and completely unreliable as a source of strategic guidance. Graham's point is not that external signals are worthless. Some of them matter. The question is whether you are responding to price or to value, and whether you have done the actual work to know the difference. Most founders have not. They are running their businesses based on the emotional temperature of the room, rather than a clear-eyed assessment of what their company is actually worth and where it is actually going. The psychological trap Graham identified, and this is the one that destroys businesses as reliably as it destroys portfolios, is confusing price with value. Price is what the market says something is worth right now. Value is what it is actually worth based on its fundamentals. Those two numbers are frequently very far apart. Acting as if they are the same is where most of the damage gets done. Once you can hold that distinction clearly, a question naturally follows. How do you actually calculate value? That is exactly where the formula lives. Here's the formula. 3 words. Graham spent decades refining it, and Buffett has spent 7 decades applying it. Margin of safety. That's it. And if it sounds too simple to be the organizing principle behind the most successful investment career in history, that is actually part of Graham's point. The ideas that protect you from catastrophic failure are rarely complicated. They are genuinely hard to follow when the pressure is on and when everyone around you is moving in the opposite direction. Here's what it means in practice. Before you commit to anything, whether a stock, a hire, a lease, or a new product line, estimate its intrinsic value as conservatively as you honestly can. Not the optimistic version, not the if everything goes according to plan version. The sober, realistic number accounts for the fact that you will be wrong about some things and that the world will surprise you in ways you did not model. Then proceed only if the price you are paying sits meaningfully below that number. The gap between price and value is your margin of safety. It is your buffer against your own mistakes. Graham's reasoning was not rooted in pessimism. He was not telling you to assume the worst about every opportunity. He was saying something more specific and more useful. You are going to be wrong sometimes. The future is structurally unpredictable. Any system that only works when you are right and lucky is not a system, it is a gamble wearing a business plan. Buffett absorbed this so completely that it became the lens through which he filters every deal. He has said repeatedly that he does not need exotic financial instruments or complicated models. He needs to find a business he understands, estimate what it is worth, and buy it only when the price gives him a meaningful cushion below that number. If the math only pencils out when everything goes right, when the market cooperates, when the product lands perfectly, and when the competitor does not respond, he walks, not reluctantly, completely, and without looking back. The entrepreneurial translation of this principle is where it gets uncomfortable, because most founders are running operations with zero margin of safety, baked in, and genuinely do not realize it. Think about the commitments that drive a growing business. You sign an office lease on the assumption that revenue will be meaningfully higher in 12 months. You hire 2 people ahead of the demand curve because you are confident the pipeline will fill in. You launch a product that requires the market to receive it well, requires your team to execute without major hiccups, and requires your cost structure to hold steady. Each of those decisions has an implicit price attached to it in capital, in time, in focus, in organizational bandwidth. The question Graham would ask is, what is the intrinsic value of what you are getting back? And how wide is the gap between that value and what you are paying? Most founders cannot answer that question because they have never actually asked it. They have replaced analysis with optimism, which feels like confidence but functions like exposure. Run Graham's rule as a diagnostic on your current plan. If the plan works when things go reasonably well, you might be fine. If the plan only works when things go exceptionally well, when the client renews, when the raise closes, when the launch outperforms, you do not have a strategy. You have a position that requires the world to cooperate, and the world has no obligation to do that. The margin of safety is what keeps you in the game when it does not just financially, but operationally. Businesses that survive downturns are not usually smarter than the ones that do not. They are protected by buffers that the others treated as unnecessary, cash reserves, conservative hiring timelines, unit economics that work at lower than expected volume. That is not caution for caution's sake. That is the math of staying alive long enough to be right. Being right in the end is worthless if you are out of the game before the end arrives. Knowing the formula, though, is only half the problem. The other half is the person holding the calculator. Graham draws one of the sharpest distinctions in the entire book early on, and most people glide right past it because it sounds like a technical definition. It is not. It is a mirror. An investor, by Graham's definition, is someone who makes decisions based on thorough analysis, prioritizes the protection of their capital, and seeks an adequate return they can actually justify with logic and numbers. A speculator is someone who bets on price movement, on what the market will do, on what sentiment will shift toward, on what will be popular next quarter, and calls it a strategy. The difference is not about how much risk you are taking, it is about whether the foundation of your decision is analysis or anticipation. Here is the part that lands differently when you sit with it. Most people who believe they are investing are speculating, and most founders who believe they are executing a strategy are reacting to a story they have told themselves about where things are heading. Think about how business decisions actually get made. A competitor raises a round, and suddenly you accelerate your own timeline, not because your fundamentals changed, but because the room shifted and you felt it. You hire 2 people in a strong quarter because growth feels inevitable and slowing down feels like weakness. You pivot a product line after 3 bad months because the pattern looks like a trend, even though 3 data points have never been a trend in the history of anything. Those are not investments. By Graham's definition, they are speculative positions dressed in the language of leadership. His test is unambiguous. Before you commit, ask yourself this: can you defend this decision with numbers and logic if the external environment goes completely quiet for 5 years? If Mr. Market stops showing up at your door entirely with no competitor news, no industry reports, no trending takes on what founders should be doing, does the underlying reasoning still hold? If the answer is yes, you are investing. If the answer collapses the moment you remove the external noise, you were speculating all along. Buffett's application of this is probably the cleanest real-world example available. He bought Coca-Cola in 1988 and held it through everything: crashes, health trend cycles that declared soda finished, management controversies, and decades of headlines insisting the brand had seen better days. He did not hold out of stubbornness. He held because the underlying business math, the economics of a product with global distribution, pricing power, and near universal brand recognition never actually changed. The vote count shifted constantly. The weight did not. He was measuring weight. The practical framework this creates for founders is straightforward to describe and genuinely difficult to execute. Start sorting your decisions into 2 buckets. The first bucket holds decisions grounded in verified fundamentals: retention numbers, unit economics, actual margin at scale, customer acquisition cost relative to lifetime value. The second bucket holds decisions driven by market sentiment: what competitors are doing, what investors seem to be rewarding right now, what the current narrative says about your category. Both buckets will always have something in them. The discipline is in relentlessly shrinking the second one. This is not an argument against being responsive to your market. Graham was not advocating rigidity. He was pointing out that responsiveness without a foundation in fundamentals is just a sophisticated way of letting other people make your decisions for you. When you act because the sentiment shifted, you have effectively outsourced your strategy to the same crowd that will be panicking in the opposite direction 6 months from now. The investor builds from analysis. The speculator borrows conviction from the room. Your business will eventually reflect which one you've been running it like, and by then the distinction is usually obvious to everyone. The problem is that even when you commit to thinking like an investor, there is a force working against you that Graham understood better than almost anyone. It does not come from the market, it comes from inside the building. Graham dedicated more pages to human psychology than to any specific financial technique, and that was not an accident. His argument, stated plainly, was that your returns in a portfolio, in a business, in any domain where decisions compound over time will be determined more by your behavior than by your intelligence. Not slightly more, substantially more. He watched brilliant people destroy their financial lives repeatedly and concluded that raw analytical ability without behavioral discipline to back it up was almost useless under pressure. The failure loop he identified runs like this: when things are going well, confidence inflates past what the evidence actually supports. You start making larger bets, loosening your criteria, treating recent success as proof that your judgment is sharper than it probably is. Then conditions shift. A bad quarter arrives, or the market turns, or a bet that looked clean starts to unravel, and the same person who was overconfident 6 months ago is now in full retreat, cutting positions that have not changed fundamentally just because the mood around them has. And throughout both phases, the internal monologue insists that this time is different, that the usual rules do not quite apply here, that this specific situation has factors that justify the exception. That loop has ended more promising careers than any market crash or competitive threat ever has. Buffett's response to this was not personal willpower. He did not just decide to be calmer than everyone else and rely on that decision holding under stress. He built structural protection into the way Berkshire Hathaway operates. Long holding periods remove the pressure to justify positions quarter by quarter. The absence of obsession over short-term earnings guidance keeps the focus on what actually matters over years, not what looks bad on a slide this month. The culture he built around patience is not incidental to the returns, it is load-bearing. The structure exists specifically because he understood that even disciplined people make terrible decisions when the environment keeps asking them to react. For an entrepreneur, the equivalent failure loop looks slightly different but runs on the same fuel. A strong quarter produces overbuilding, new hires, expanded overhead, accelerated timelines that assume the good conditions will continue. A weak quarter produces the opposite. Across-the-board cuts, pivots away from things that have not actually stopped working, a kind of organizational panic that mistakes contraction for decisiveness. In both directions, the person making the decisions believes they are responding rationally to the situation. They are not. They are responding emotionally to the temperature and then constructing a rational-sounding explanation after the fact. Graham's prescription for this is rules-based decision-making, and the timing of when you write the rules is everything. Criteria established before the emotion arrives function completely differently from criteria you develop in the middle of a high-stakes moment. When you define in advance exactly what would need to be true before you make a particular decision, you remove the ability to rationalize exceptions in real time. The rule does not bend because the pressure is high. That is the entire point of writing it down first. The concrete version of this for a business looks like a set of pre-committed thresholds. What retention rate actually justifies adding a new hire rather than what feels right when the team is stretched and the quarter looks strong? What margin number triggers a pricing review before you have already spent 6 months defending a price point that does not work? What runway figure forces a structural conversation before you are having it with 3 weeks of cash left? These are not pessimistic questions. They are the questions that let you act from analysis instead of from adrenaline. The discipline Graham is describing is not emotional coldness. It is a different relationship with your future self. Every rule you write now is a promise to the version of you who will be sitting in a harder conversation later with more pressure and less objectivity. That future version will be grateful the decision was already made. And all of it, the rules, the discipline, the structural patience, depends entirely on one final variable that Graham was more explicit about than almost any other writer in business history. Graham's entire framework rests on a single assumption that sounds obvious until you actually try to build a business around it. In the short term, price and value diverge constantly. In the long term, they converge almost inevitably. That's not an opinion or a market philosophy. It's closer to a law of financial gravity. Every distortion, every panic, every mania, every quarter where the voting machine goes haywire eventually gets corrected by the weighing machine. The question isn't whether the correction happens, it's whether you're still standing when it does. This is why Buffett's favorite holding period is forever. People repeat that line as though it's a personality quirk, a charming eccentricity from a man who still lives in the same house he bought in 1958. It isn't. It's a mathematical strategy. If value and price converge over time, then the longer you can hold a genuinely good position, the more certain the convergence becomes. You're not waiting out a bad market, you're letting the physics of the system do what it will inevitably do. And your primary job is to not interfere with the process before it finishes. The compounding effect Graham described operates identically in any system where quality inputs are repeated consistently over a long enough period. A business that consistently delivers real value to its customers, that keeps its cost structure rational and its talent treated well, that does not blow itself up chasing the quarter, does not just survive. It builds a kind of durable advantage that competitors operating on shorter time frames structurally cannot replicate, because replication requires time they are not willing to spend. Most founders operate on a 90-day horizon, and not because they chose it deliberately. The culture around them selected it. Quarterly reviews, monthly targets, the entire vocabulary of growth at all costs optimizes relentlessly for the near term and treats long-term thinking as a luxury available only once you've already made it. Graham's framework is not just incompatible with that time frame, it actively exposes how much damage that time frame does. Every time you sacrifice a compounding asset for a short-term number, you are paying a price that will not show up on this quarter's report, but will absolutely show up eventually. The practical implication is not abstract. Inside any business, there are two categories of decisions: those whose returns arrive in days or weeks, and those whose returns compound across years. Customer relationships built on genuine service. Internal knowledge systems that make the team faster over time. Brand credibility built through consistent delivery rather than aggressive positioning. These compound. Most of the things that fill a founder's calendar, the reactive emails, the meetings that could have been a message, the tactical pivots chasing this month's signal, produce linear results at best and actively consume the time that compounding assets need to grow. Buffett reads roughly 500 pages a day. He's kept that habit for decades. This is not discipline theater or a routine worth copying blindly. It reflects a specific understanding that knowledge is itself a compounding asset, that what you know today makes tomorrow's reading more valuable, which makes next year's decision-making sharper, which produces returns that accelerate the longer the system runs. He's not reading to be informed. He's investing in the compounding curve of his own judgment. And he started early enough that the curve has had 60 years to run. Most people stop investing in their own understanding the moment they feel competence. Competence is the point where the linear return feels sufficient, and the compounding return is still invisible. That gap between what you have already learned and what would happen if you kept going is exactly where Graham's time horizon lives. And almost nobody is willing to stay in it long enough to find out what is on the other side. Graham never intended the book to be read once. Buffett has returned to it at different points in his career precisely because the application shifts as the stakes shift. What the book teaches a 19-year-old with no capital to deploy is not the same thing. It teaches someone managing a complex organization with real downside exposure. The framework scales because the principles do not change, only the context they are operating inside. So here's how you actually build this into the way you run a business, not just the way you think about running one. The first layer is defining your intrinsic value metrics. This means knowing your real numbers, unit economics, customer lifetime value, true cost of capital, not the version that assumes everything trends in the right direction. Most founders know their revenue. Far fewer know what it actually costs to generate $1 of it when you account for churn, support, and the time the team spends keeping existing customers before you even get to acquiring new ones. You cannot apply a margin of safety to a number you have not honestly calculated. The second layer is building a written MR market filter. Every week, something will arrive demanding a response, a competitor move, a market shift, a piece of industry news that the group chat treats as urgent. You need a written set of criteria that determines, before the pressure arrives, which signals deserve a strategic response and which ones you close the door on. Without that filter, you are just reacting. And as Graham showed, reacting is how smart people systematically underperform their own potential. The third layer is establishing your margin of safety thresholds in advance. What is the minimum return that justifies a new hire? Not just in revenue upside, but in the realistic probability that the hire produces it within a defined window. What is the maximum you will spend to acquire a customer before the unit economics break? And do you have a number or just a feeling? Write the thresholds before you are sitting across from an exciting opportunity, because that is the only moment when they will actually function as protection. The fourth layer is the hardest to implement and the easiest to delay. Audit where your time actually goes against where the compounding returns live. Most founders, if they track this honestly for 2 weeks, find that roughly 80% of their activity produces linear or temporary results. The compounding work, building systems, developing people, deepening customer relationships, acquiring knowledge that sharpens future decisions, gets whatever time is left after everything else makes its demands. Graham's framework suggests inverting that ratio is not just preferable. Over a long enough time frame, it is the only move that actually separates the outcomes. Graham's most underrated observation for anyone building something is this: the market will correct itself, but you cannot predict when. Your job is not to be right at the perfect moment. Your job is to stay solvent, stay rational, and stay in the game until the correction happens. That means your system needs to protect your downside as seriously as it pursues your upside. Most business systems are built entirely around the upside. The downside protection is assumed until it is not there. The reason most people read this book and do nothing with it is that the system demands something most people are not willing to give: the willingness to be boring on purpose, to say no to the opportunity that does not clear the margin of safety threshold, even when everyone in the room is excited about it, to hold through the quarter that looks bad because the fundamentals have not changed, to build a filter and then actually use it when using it is inconvenient. That is the formula, not a mathematical equation, not a secret algorithm. A set of behaviors applied consistently over a time horizon most people will not commit to. Graham's entire framework, the margin of safety, the Mr. Market filter, the long time horizon, is really one instruction underneath all of it: stop dividing your attention and go all in on what actually holds weight. That is where the next video picks up. The book every seven-figure founder keeps returning to is not about investing. It's about a single idea that most productivity advice contradicts directly, and the research behind it suggests that founders who ignore it are leaving more on the table than they realize. Most people read it and think it's telling them to be more focused. It isn't. It's telling them something far more uncomfortable about how success actually compounds, and why doing less is the one move that makes everything else hit harder. If you want to know what that book is, what it actually argues, and how to use it to build the kind of leverage Graham was talking about, that video is next.